With credit being so important, today we're going to talk about your credit score and what it is comprised of, like what percentages are used to determine your credit score, which gives you your rate and terms when you're buying a home. So there's a few factors. Payment history is 35% of your score. Making debt payments on time every month benefits your credit scores more than any other single factor. And just one payment made 30 days late can do significant harm to your scores, as much as a 40-point drop. An account set to collections or foreclosure or bankruptcy can have even deeper, longer lasting consequences on your credit scores. So your payment history, again, will account for about 35% of your FICO score. Now, the second piece is the amount that you owe. That's comprising 30% of your credit score. The total amount you've borrowed affects your credit score, as does the portion of your available credit tied up in your outstanding balances. Your credit utilization ratio, or rate, the percentage of your total borrowing limit you're using on your credit cards and other revolving accounts, is a significant factor in determining the credit scores. It's one of the most important factors that is responsive to your actions. For instance, if you pay off a high balance credit card one month, you'll see a big boost in your credit scores because that is paid down the high limit. To calculate your utilization, you divide your outstanding balance on each revolving account by its credit limit and multiply it by 100 to express the answer as a percentage. Credit scoring systems consider the utilization rate on all accounts individually and on the totality of all accounts. Here's an example that I'll explain. Individuals with the highest credit scores tend to keep their utilization rates below about 10%, and utilization rates roughly 30% or greater will create more negativity on your credit scores. So paying down the higher balances can bring a quick score improvement. So in this example, we're going to focus on reducing the balance on cards that can lead to quick increases in scores, which I do often for my clients. The amounts owed are responsible for 30% again of your score. For example, if you have a Target credit card with a $1,000 high credit limit and you charge $900, but you pay it off the following month, the credit score gets reported at the end of the month, so you haven't paid it yet. So it's showing that you owe $900 out of $1,000, which is 90% of your max credit. That's going to impact your score negatively. Simply paying that off on the 25th of the month instead of waiting till the bill is due on the 10th will increase your credit score 20 points. So when paying off cards, you can often look at doing it around the 27th of each month and trying to get the lower credit cards that have the lowest high limit. Paying those down will keep your credit scores up. So if you're 27 years old and your credit is newer, maybe you just bought a car 10 months ago and you have a credit card that's a year old, and that's basically it. You're not going to have a very high credit score because you don't have a lengthy credit history and you don't have enough credit history. Conversely, when I do credit applications for my clients in their 70s and 80s, I see many scores over 800 every day on that. That's because they have a mix of credit, they have the length of credit, they pay their stuff on time, they set up auto debit. So let's talk about the length of your credit history. It makes intuitive sense that experience with credit accounts will tend to make you better at managing debt, and that's borne out by statistical analysis. For that reason, all else being equal, the longer your credit history, the higher your credit score will tend to be. The FICO score evaluates your experience with credit by measuring the age of your oldest credit account and the age of your newest credit account and the average age of all your accounts. Note that closing accounts and paying off loans in full caps the payment history for those accounts, but it doesn't immediately cancel out their ages for purposes of calculating the length of your credit history. So accounts you choose to close that were in good standing, meaning no late payments, will remain on your credit report for as long as 10 years, and they do help you. The length of your credit history, again, accounts for 15% of your credit score. So the next piece that makes up your credit score is the credit mix. That accounts for 10% of your score, and that's the ability to successfully manage multiple debts, and different credit types tend to benefit your score. The credit scoring system favors a mixture of debt, such as student loans, mortgages, car loans, and personal loans, and also revolving accounts like credit cards create your mix. If you strictly just have 3 credit cards, that's not a mix. So that's why older people tend to have better scores. They have more of a credit mix because of their age and credit history. The last piece that will affect your credit, and again, it has about a 10% weight, is new credit. It's a statistical fact that new debt raises the odds you'll fall behind on your old debts. So credit scoring systems, therefore, may ding your score a small amount in response to hard inquiries. Those are hard credit pulls, entries that appear on your credit report when a lender processes a credit application from you, or when you go buy a car, the bank looks up your credit score. Your credit will usually decrease less than 5 points for an inquiry, and if you keep up with your bills, your score will typically rebound within a couple months. Hard inquiries are not all treated the same, however. Credit scoring models see rate shopping for the best rate and terms on installment loans such as mortgages, car loans, and student loans as a positive behavior. In these cases, they lump together those hard inquiries if they're made within a short period of time with the same loan. Like 2 weeks is a good period to go shopping for a mortgage or a car, and consider them as one inquiry. So note that hard inquiries can be made in relation to credit card applications. They don't get the same treatment. Each inquiry is considered separately and have a bigger impact on your score if you apply for several credit cards in a short time span. So again, new credit is responsible for about 10% of your FICO score. Obviously, we've discussed a lot about credit and what impacts your score. Please feel free to give me a call at 773-848-4144 for us to run your credit for you at no cost. And we can also do a credit score indicator to help you realize and gain a score of 800 or better to get the best mortgage terms that you can.